Most of the headlines obviously follow public transactions, but there's also been a fair amount of activity in private transactions, and I think it's worthwhile thinking about some of the issues that come up in those transactions. And obviously the issues vary depending on the type of transaction, but if you have a larger company that's selling a subsidiary or division of itself as opposed to a company that just happens to be private selling all of itself, you tend to see different issues, at least with respect to figuring out what the seller wants to sell and what the buyer wants to buy. And so therefore you have to, if you're a seller, ask yourself, what do I want to sell? Do I want to sell all the assets that are exclusively related to this business, or do I want to sell the assets primarily related to the business? What liabilities do I want to transfer? I mean, if I'm a seller, I normally want to transfer all the pre-closing liabilities, and if I'm a buyer, I want to take as few of them as possible. You know, the situation is exacerbated if there are issues with respect to separation. Most people who are selling a business tend to think of that business as a separate business, but when they actually come down to thinking of selling it, they come across issues with respect to shared assets, whether they're employees who work in the business being sold and the business being retained, or whether it's intellectual property. And an intellectual property can be particularly tricky because obviously it is generally a very important asset of a business being bought. But if the IP that's used in that business is also critical to the businesses being retained, then people have to figure out a way to share that IP going forward. One issue that is not so much an enormous substantive issue, but it can give rise to a timing issue, is whether the seller is going to have to provide audited financial statements for the business being sold. And if the business being sold is substantial, the buyer will often require them to give it comfort as to what it's buying. And if it's financing the transaction, its financing sources will often require audited financial statements to be delivered as a condition to providing the financing. And putting together audited financial statements, particularly if they have to go back 3 years, takes time. And so one of the things that the seller should talk about to its bankers, in particular if it has them, is, do you think we're going to need audited financial statements to get this deal done? And if the answer is yes, they need to start preparing those sooner rather than later. The other thing that people spend a lot of time thinking about in private transactions is post-closing recourse. Is the seller going to stand behind its representations and warranties? And if so, for how long? And is its liability going to be capped either at a specific monetary threshold or by reference to a particular type of liability that it's retaining responsibility for? The other thing that a buyer has to think about for a private transaction is, how is it going to ensure that the money will actually be there if it seeks indemnification? If the sellers are individuals, obviously they could give the money away to their significant others or to charity. And if the seller is a shell company, can obviously just dividend it out and it has no other assets. So people look at holdback arrangements or escrow arrangements or set-off arrangements, which can be very useful if the buyer will make post-closing payments to the seller in respect of things like transition services or supply arrangements. One of the first questions is, how do I want to structure my transaction? Do I want to do a merger or do I want to do a tender offer? And generally speaking, at least if there are regulatory or financing issues, people structure public transactions as a merger. If there's an hostile or unsolicited transaction, generally the first step is a tender offer made directly to the shareholders of the target company. You know, the theory being that the more shares are tendered into the tender offer, the more pressure is put on the board to accept the offer and eventually capitulate, which sometimes works and most often doesn't work, or both. In a couple of the recent transactions involving private equity firms, they used a dual track structure. They did a tender offer where the minimum condition was such that you could do a short form back-end merger immediately after the closing of the tender offer, and they also went down the road of a merger structure embarking on a proxy process. And whichever got to the finish line first was the structure they would use. People in public deals also tend to be focused on certainty of closing, in addition to value, obviously, and they can sort of tie in together because from the buyer's point of view, it will generally want to close the deal it's signed and announced, particularly if it's a strategic buyer. And from the seller's point of view, it will want to close the deal because of the disruption to employees and customers and suppliers, but it will also want the flexibility to accept a better deal if it comes along. So you see sort of a tension that is dealt with in a couple of ways in sort of reconciling these 2 points of view. One is if preserving for the board of the target company the ability to accept a better deal. And the way of doing that tends to differ between strategic deals, i.e. when the buyer is another company, as opposed to when the buyer is a private equity firm. And I think the theory for the additional flexibility for target companies being acquired by private equity firms is that for the private equity firm, the deal is primarily a financial one. And so it can be compensated for its disappointment by the payment of a termination fee. For a strategic buyer, the deal tends to be that, strategic, and therefore it'll be less likely to countenance its deal being shopped or to accept, a termination fee as a disappointment fee. But in all public company transactions, with one exception, which I'll talk about in a second, the board will have the right to change its recommendation of the transaction, and it will have the right to respond to and engage in discussions with respect to a better proposal. People have sort of now said, okay, at least in some circumstances, I want to treat my private equity buyer like a strategic buyer, i.e. I want the right to seek and obtain specific performance so that my transaction can close. And those tend to be in circumstances where the acquisition financing for the transaction is available. And to take it one step further, in some transactions you'll see that the target company has the right to cause the sponsor to enforce its debt commitment letter or its financing agreements. And so, the trend is towards greater certainty of completion of private equity deals. And if there isn't specific performance available because, for example, the financing isn't available, then there's a tendency towards asymmetrical termination fees, i.e. it's more painful for the private equity firm to walk away because the fee it has to pay to the target company is more than twice the amount of the fee it would receive if the target company terminated. In private equity transactions, it will sometimes, and reasonably often, actually have the right to go out and solicit transactions that are better for some period of time after signing, the so-called go shop. And the go shop generally lasts between 30 and 45 days, with 30 days probably a little bit too short to be really useful, and 40 to 45 days being more of the norm. And you sometimes enhance the auction process that's meant to be generated by the go shop by having a two-tier termination fee for the target company, i.e. if it terminates the agreement to accept a better proposal that came in during the go shop period, it will pay a fee that's maybe 50% of the normal 2 to 4% termination fee. Go shops, as I mentioned, tend to be used in private equity transactions, but they're probably being used less than they were when they first started. And experience has shown that they actually don't result in a better transaction that often. I think about, fewer than 20% of the transactions with go-shop provisions actually attracted a better bid. When buyers and sellers are focused on certainty, in addition to sort of, closing conditions with respect to will you get stockholder approval or will you get any third-party consents, the other big one out there tends to be, are there any regulatory issues? Will we obtain the necessary regulatory, and usually it's antitrust, if you're not operating in a specialist industry, clearances. And when people think about those, they look at the level of efforts that the buyer is going to have to use to obtain the regulatory approvals. And those efforts tend to span from commercially reasonable efforts, which is sort of on the low side, to the so-called hell or high water provision, which basically says, I as buyer will do anything it takes, including selling the business I'm buying, to obtain the necessary regulatory approvals. Those provisions are rare. The other thing that you sometimes see is the buyer will agree to pay a reverse termination fee if the regulatory clearances aren't obtained. Now, you don't see that very often because it's really painful for a buyer to do that. By definition, when it pays the fee, it has nothing to show for it because the transaction won't have closed, which is obviously unlike the more typical termination fee. When the company pays the fee, it's paying it only because it has a better deal out there. In public company transactions where there are significant stockholders and we're representing the buyer will often ask, well, can I get the significant stockholders to agree to vote in favor of the deal upfront or to agree to tender their shares into the tender offer? And unfortunately, the answer is sometimes no, because there was a 2003 case in Delaware involving a company called Omnicare, where the Delaware court held that a board could not countenance a transaction being locked up. As a result of which, since that case, people have not really locked up transactions. So what you often see if there are significant stockholders who are readily available and are non-institutional is that they will agree to, vote shares in favor of the transaction or tender into a tender offer so long as the shares do not constitute more than 50% of the outstanding shares. You often also see that if there is an intervening event, such as the board changes its recommendation, that the voting agreement or tender agreement will remain in effect, but it will cover fewer shares, on the theory that if there's a sort of a legitimate reason for the board to have changed its mind about the deal, the transaction should be less locked up under those circumstances. The other thing that will happen is if the agreement is terminated with the first buyer, the voting agreement will also terminate. Now, there's one exception to the lockup rule, which you can use if stockholders can act by written consent. Unfortunately, for most U.S. public companies, it's very rare for a company to allow its stockholders to act by written consent and has to be provided for specifically in the certificate of incorporation. But when they can, the Delaware courts have held that it is permissible to get stockholders to deliver written consents immediately after the merger agreement is signed, and therefore you've eliminated any interloper risk. Clients ask, where do we go from here, or what do you see happening over the next couple of years? And I mean, essentially it's difficult to say, because there's still, I believe, a fair amount of uncertainty. And while M&A activity levels are definitely improving and better than they were, I mean, I believe that there's continuing caution out there and enthusiasm for large or sort of bet the company transactions is somewhat tempered by a fear that the other shoe is going to drop, any moment, whether it's in the form of a sovereign debt crisis or a commercial real estate crisis or, some other crisis. But having said that, large amounts of cash have been accumulating over the last 3 years in the coffers of both strategic companies and private equity firms. And I think those companies are going to come under increasing pressure to deploy that cash productively. And obviously, one thing that's seen as a productive way of deploying cash is to acquire other companies. If another shoe doesn't drop and the pressure continues to deploy cash, I believe we may see a continued focus on certainty and on value, i.e. if you're a seller, getting the best value possible for your company. And I think that the leverage, the negotiating leverage, may sort of swing back to the seller a little bit, where it's, people could say that it's sort of been a buyer's market for the last couple of years. I think that may change.